For years, Indonesia was heralded as Southeast Asia's unstoppable economic darling, confidently printing a steady 5% annual growth. But right now, a silent financial panic is unfolding. In a matter of months, global funds have dumped over 70 trillion rupiah, nearly $3.9 billion, in Indonesian equities. It is the most violent foreign sell-off the archipelago has witnessed since the dark days of the 1997 Asian financial crisis. The national currency is hitting historic lows, and the stock market has plummeted into one of the worst global performers. Why is the world's smart money suddenly running away from this economic giant? The first crack in investor confidence comes down to a clash between massive political promises and harsh mathematical reality. Newly elected President Prabowo Subianto entered office with a dream of pushing growth to a skyrocketing 8%. To get there, his administration rolled out hyper-expensive welfare programs, chiefly a nationwide multi-billion-dollar free school meals program. While highly popular domestically, international bond markets panicked. Investors watched the nation's fiscal deficit widen to its highest level in 2 decades, dangerously flirting with the legal 3% cap established post-1998 to protect the country's creditworthiness. When rating agencies responded by slashing Indonesia's outlook, global asset managers packed their bags. Then came an unexpected external shock. Geopolitical conflict exploded in the Middle East, closing the vital Strait of Hormuz and driving global crude oil prices through the roof. Here is the structural trap. Despite being a resource-rich nation, Indonesia is a net importer of refined fuel. To protect its citizens from runaway inflation at the pump, the government chose to absorb the blow, injecting an unplanned emergency $6 billion into untargeted fuel subsidies. This sudden drain on fiscal reserves, colliding directly with Prabowo's expensive welfare bills, left international markets terrified that the state's coffers were being entirely mismanaged. It gets worse. Capital isn't just fleeing because of government spending. It is fleeing because of a structural breakdown in market trust. The elite global index provider MSCI temporarily froze the rebalancing of Indonesian equities. The issue: deep-seated regulatory anxieties regarding transparency, corporate ownership opacity, and rampant stock frying. A practice where local bad actors engage in coordinated, artificial trading to manipulate asset prices. The threat of Indonesia being systematically downgraded from a premier, emerging market status to a volatile frontier economy sent shockwaves through institutional banking circles. Many massive global pension funds are legally barred from holding frontier assets, triggering automated, preventative sell-offs. Ultimately, Indonesia's massive capital flight offers a critical lesson in global economics. Economic growth cannot survive on political ambition alone. A nation can boast vast populations, surging raw resources, and immense potential, but global capital demands predictability, regulatory transparency, and absolute fiscal discipline. Until the administration demonstrates clear contract execution, restores central bank autonomy, and reins in runaway populist deficit spending, the world's investors will continue to watch from the sidelines. Growth requires trust, and once trust flees, the money always follows.